Hey Fools, I'm Eric Bleeker. I'm joined here by Matt Argersinger. This is a show we're calling Motley Fools the Next, where we're not going to look just only at kind of some trends from the past week, but also take out the crystal ball, a little future-based look, because hey, there's a lot of cool stuff going on. Joined once again by Matt Argersinger, who heads up our Odyssey One portfolio, which is part of Supernova, kind of the Motley Fools top-end growth service. So a man who knows what he's talking about, or we should hope so.
And most of the time, yeah.
Most of the time. So we're going to start looking at some stuff from the now, which is actually kind of events across the past week and longer term kind of impacts from them. I want to talk about Weibo. It's going to be an IPO of, if people aren't familiar with Weibo, a microblog service, which is kind of a mix between Twitter and Facebook in China. I don't really even know how you describe it. It's just a little bit different, but very popular in the country.
Huge.
And you know, there's been a lot of talk of it. Its parent company is Sina. A lot of talk about Weibo going public. But we're also seeing right now kind of some pullback, especially in Chinese internet stocks. We've seen Tencent off about 20% from its peak. Alibaba's getting in fights with banks in the country. And now there's a little more uncertainty around this. As Weibo goes public, what are your thoughts on the company?
Well, so Sina is actually a 3-time recommendation in our Odyssey One portfolio, and of course they own 71% of Weibo. So you have Sina, which is by itself a pretty popular internet portal. I think it's still the leading internet portal in China. Some people call that the Yahoo of China. But of course, 4 years ago they started Weibo, which is like a Twitter-like service. It's very similar to Twitter. Actually, you can do 140 characters. Of course, Chinese characters. You can probably say a lot more.
I think it's like the equivalent of 70, 80 words. Right?
Okay, yeah. So it's a lot. So it is more. It is, like you said, like a mesh of Facebook and Twitter in one. And if you look at the user growth, I think on a monthly basis they've hit almost 100 million users. On a daily active basis, they're well over 50 million. So it's very popular, probably going to go public soon within a month. And the valuation range for Weibo, if you look at it, it's between 4 and 8 billion. Sina owns 71%, and Sina today is trading below 4 billion. So it's a little bit of a financial catalyst for Sina. But you also get ownership in what is probably a very popular service. I think the misconception here, though, and the reason Weibo and some of the others have sold off, is that there's this whole idea that Weibo, which is a social media company, might be losing out to WeChat from Tencent, which is a social network company. And I think, no, in my view, there's room for both. Because social media is like Twitter, Instagram to a certain point, Weibo, it's all about connecting, making it's an autonomous relationship you have to people who are following you. You're posting stuff, you're sharing it across networks, people who are following you get it. It's great for corporations to spread their brands, it's great for government agencies to report things, but it's not necessarily a tight network of friends or colleagues or that I'm worried about communicating with. So I certainly think there's room for both. I'm really excited about Weibo. I think I know you are because we've talked about it, and Sina is an interesting way to play it.
Yeah, definitely. And if we look at the tail of the tape for people who might not be familiar with it, 56 million in ad revenue in the fourth quarter, up 163% year over year. So still good growth. 15 million revenue other than ads. Compare that to Twitter, which had 243 million. So it is still quite a bit smaller than Twitter.
Right.
But again, Sina's worth 4 billion and Twitter's worth nearly 30 billion. So there's the difference here. Also, the company has 1.6 billion in net cash. So if it's worth 4 billion, well, that's almost half of its value right there. I think one of the kind of interesting areas to look at with this, Baidu's a company that I've long been a big fan of. It's very interesting and it has good placement. But when mobile first came out, everyone was very terrified that Baidu was not immediately monetizing mobile extremely quickly, especially because Google's dominant there. But as we saw, in China, Android is not really Android. It's an entirely different version of it. Baidu weathered the storm, and now they're doing very well. I think there's a similar kind of trough of disillusionment right now, because everyone's wondering where these kind of messaging platforms like a WeChat fit kind of into the broader structure of kind of social networking. You saw Facebook obviously buy WhatsApp for 19 billion. There is a question of how they're going to fit in. But like you said, it's far from determined that Weibo would in any way be knocked off its pedestal and that these two couldn't even be in some ways complementary to each other.
Exactly.
So I think once investors kind of move past the shiny thing of the moment. Weibo is a company that's been growing, again, advertising revenue by 163% a year. And China is a pretty large ad market. I believe it's the third largest in the world. It's about a quarter of the size of US. And it's an ad market that was kind of born digital. You know, in the US, so much of our ad market is with television.
Right.
Here's an ad market where you have a lot more focus on being able to reach people because their first exposure to media wasn't a television 30 years ago. It's to a smartphone in the past few years. And that's a place that Weibo is extremely well
Absolutely.
positioned.
I mean, Weibo is built for mobile, and if you read the F1, the foreign filing for Weibo's IPO, you can management's all about being mobile first, growing out the mobile part of Weibo, and like you said, in China, it's fascinating. There are actually, I might have this wrong, but I remember reading that less than 50% of Chinese actually own a television. So it's really all about it's a smartphone or maybe eventually a tablet, but this is how they're experiencing it. And by the way, as of the end of 2013, I think there's something like 500 million smartphone users in China now, so it's a humongous market.
All right, let's move on from Weibo. Some good discussion there, but I'll keep it in social media. Twitter has fallen quite a bit from its peak. It was over $70 per share, and now it has fallen back to, as of this filming, about $46 per share. I saw one headline blaring at the top, Twitter stock in free fall. Now, to me, that requires a little perspective because they still IPO'd at $26.
Right.
What are your thoughts on Twitter and maybe some of the pullback in broader social media stocks, including Facebook as well?
Sure. Well, so people, Twitter is essentially back to where it was after its first day jump after its IPO. I'm a user of Twitter. I'm a huge fan of Twitter. This is a space. Facebook, LinkedIn, they're all there where they've had just tremendous runs. I mean, over the past year and a half or 2 years, and they're going to give some back, and I think Twitter's kind of being tossed in that. There was also early when Twitter had its first quarter, there's a little bit of slowing in the user growth there and user engagement there. Again, it's one of those things where it's going through growing pains, but I think they're still just at the beginning of really monetizing this platform. And to me, it's a very powerful platform. It's nowadays how celebrities, government officials, corporations. This is essentially how they're sharing the latest news or their real-time thinking. And we really haven't had anything like that before. I mean, Twitter is constantly open either on my phone or on my laptop. And that's because I'm usually getting my news and my insights on Twitter well before I am anywhere else. And so to me, it's very powerful. I don't think they've even scratched the surface of how they can monetize it. So I'm kind of, as an investor, I don't own shares in Twitter, but I'm kind of happy to see it come down a little bit because this is one I've certainly had on my watch list for a while.
Yeah, and the interesting thing for me about Twitter is there are some kind of conflicting signals for me right now. I'm a power user of Twitter, but then again, my job is to absorb information. So I can't really say that I speak for the average person on this front. And we did see the data recently of, 11% people who signed up for Twitter in the previous year still using it. Or maybe that was 2012. But the point stands. Right. A lot of people who are signing up aren't still using it. So it's kind of a contrast for me where Twitter obviously offers a very differentiated platform than Facebook, but in that exchange of information, often likes on Facebook are kind of a broken system right now because the loudest people are constantly liking stuff and taking up your feed.
Exactly.
And as a result, a lot of people have voiced a lot of displeasure with the usefulness of the feed. Twitter allows you to really tailor it and be able to get your information, as you said, people going there, even government agencies being able to broadcast news. So I think it's a superior system for that kind of information dissemination. I still haven't quite decided how that scales because it's a $27 billion company right now. But that's been kind of my thought process on it. So I'm of definitely two minds on Twitter right now. I personally kind of like Facebook a little more. Even though I just said that the feed system is a little broken, I still think Facebook has a lot more going for it, where this is the core of what Twitter does. Of the two companies, which one would you kind of prefer right now?
I'm a Twitter fan, and probably even as an investment, I'd also stick with Twitter. I mean, Facebook's, like you said, Scott, and I know we're going to talk a little bit more about Facebook in a future segment, but I just, the one thing that gets me about Facebook is probably the same thing that gets you about Twitter. It's a massive market cap for such a young company, 160 billion in Facebook, and like you said, about 25 billion for Twitter. And so it's, granted, these guys, the companies are growing like crazy, but how much can they grow where they can be good investments today? That is the question.
Yeah. Okay, let's keep moving on. Cloud computing. this week we saw Google drop prices anywhere from about 30% to, for some data analysis functions, 85%. Now, everyone's heard cloud computing, future, yada, yada. We get the storyline. The question is, these companies kind of providing the infrastructure for other companies to build on. Is this a business that investors are going to be able to see really good returns from the leaders on in the future? Because obviously right now it's Amazon.
Right.
Google is getting serious about it, but there's also smaller players like Rackspace.
I don't think so. I think if you're talking cloud infrastructure, I expect to see the same thing going forward that we've seen recently, which is massive price cuts. So Google, as you said, Google cut their prices. Amazon the next day slashed their prices. And I think that was, if I have these numbers correct, that was the 42nd time Amazon has cut its cloud prices over the last 6 years. And so clearly, when I look at big tech, and I think Microsoft with Azure is going to follow suit pretty soon with cutting their prices. And so with big tech, it's all about, listen, we know this is a commodity business right now. We know we're essentially all providing the same thing. But it's the services and it's the ecosystem that we can provide around that to these developers that are what we're going to, that's where the margin's going to be. That's what we're going to be going after. The problem with a company like Rackspace, when you're a pure play infrastructure company and you don't have anything else really, besides some basic services that you can offer your developers, it's kind of like, I tweeted this the other day, it's kind of like being the general mom and pop store in the small town when Walmart's building their store a mile away. You might offer great service and people might love your store and love your, you. But at the same time, if a competitor is cutting their prices by 50% versus you, you're not going to last long. And I think that's what's happening to Rackspace. And so I'm very concerned about companies that are really purely on cloud infrastructure. The big tech companies who are able to provide this stuff and have other business lines that are obviously much more profitable and growing faster, or at least on a profit basis, those are the ones it's not really going to matter, and they're going to squeeze out the smaller guys.
Yeah, I would agree with you on this one, that whenever Google enters the field and gets aggressive, you always have to watch out, because you could have said immediately when Google, for example, put out their Office apps, you could have said, oh, Microsoft's in trouble, but we've seen very little dent, and I believe that just became a billion-dollar market for them. Mm-hmm. In this case, Amazon's done so good to wrap up all of the startups in their platform, and they will continue cutting costs. And because they've built a lot of services on it, I think that it can be profitable for them, even competing in a Google world, because they even have things like a marketplace built on top Amazon Web Service that I saw one analyst saying he believed it would be 40% of the value of the whole platform, just because it provides such high margin sales. They take a cut. It's basically like an app store for Apple, if you wanted to think of it that way. So I think that this is definitely a space for the big players where they can find their own space. But like you said, those niche companies, it's going to be very tough for them to find their place. And I think it won't be because they have a natural market. It will only be because of excellence within the companies to be able to find that right market position. And we've seen some leadership leaving Rackspace recently, so it doesn't exactly leave you confident that they'll be able to weather this.
Yeah, I mean, one of the things David Gardner looks like we look at in Supernova Rule Breakers is pricing power. And as great as a company is, management, story, the culture, as soon as you lose pricing power, it's kind of your death now, unless you do something else.
Yeah. All right, let's move on to Amazon. Well, let's stay on Amazon. Why not? But let's move on to video. Wall Street Journal comes out with a story that Amazon's going to basically put out either parts or all of its video library and do advertising on it. Amazon responds and says, no, we're not. But you figure they could have responded to Wall Street Journal initially asking them when they denied the request. But that's neither here nor now.
Let the story get out there and let it percolate first.
So there's probably some truth to this, that they've been testing it. Whether or not they'll roll it out isn't to be determined. The obvious player that this is going to affect is Netflix. As someone who owns Netflix or has recommended it, how do you feel about these developments?
Anytime Jeff Bezos gets involved in a particular market, I get nervous, even though I also own Amazon. Because, as he said in the past famously, your margin is my opportunity. And I feel like he thinks Netflix and some other players potentially are treating this type of media as a subscription-based business, as they have, and they've been very successful at it. I think he's saying, well, Amazon's a big player. We have negotiating power. We could, strike content deals as well and provide it for free. Now, they haven't actually said they're going to do that, but if they did, I think that this is a bit of a threat. I'm glad Netflix has gotten into its own content development, because I think that's one of the things that's going to distinguish it. So it's good for, I mean, it's good for Amazon. It's good for content developers. A little bad for companies that might be trying to provide streaming. I still think Netflix is going to be fine in this, even if Amazon goes full horse onto this. It might be some of the smaller, more niche players that we should be worried about.
Yeah, and I'm sure Jeff Bezos is well aware of these issues. But some of the problems I see as far as advertising on, basically TV shows on the internet. Right now, the reason that so many people are attracted to this is because the RPM, the industry term for dollars you get per 1,000 views, right now on web TV, it's about $23. So $23 per 1,000 views.
Okay, yeah.
On pay television, it's saying about $15. So you actually have this elevated situation where you can get more for it. So that naturally brings a lot of appeal to people. But where television kind of advertising has been, there's always been such a low inventory of available ads. It's not like online where you look at YouTube, how much content is constantly running. So it's been a pretty stable ad market for decades, you could even say in some ways.
Sure.
But online, things can ramp up so fast that if one company is doing something predicated on the idea that they can get $20 plus RPMs, and a ton of people start copying it and all that inventory floods the system, you can see it rapidly drop. So an idea that was built on the economics of when you got into providing video for free with ads on top of it might not hold 6, 7 months, a year later. So I think, Amazon's looking at this, I'd be surprised if they got into it, because definitely, too, Netflix has probably thought about ways that they could do this and came to the conclusion they shouldn't, because I think it's a very difficult market once you get into it. And, we've even seen another company like Hulu trying this, and I don't think that company's ever scaled to the size even close to something that would be meaningful for Amazon.
Well, right, and I guess from a consumer perspective, I mean, I'm paying $9 a month to Netflix, or $8, I can't remember. It seems so insignificant for what I get. I mean, I'm watching Battlestar Galactica right now. I'm going through all four seasons right now. And if you told me that I could watch the episodes, but I'd have to watch a few ads in between, to be honest, I'd say it's $8 is worth it for me to not see ads. So I don't know. I don't think it's a big a threat. The question between Amazon, YouTube, or things like that, or Hulu, like we talked about, maybe a different discussion.
Yeah. All right. And final kind of now issue. King Digital IPO this week, the Candy Crush IPO. Any thoughts on that?
Well, the fact that it didn't get the typical IPO 100% pop that we've seen over the last few months, and the fact that it's actually down, I think at this point about 20% below its IPO price, it kind of makes me think there's a little bit of sanity coming back to the market. It also makes me think that finally investors are being a little rational here, because this is a very highly profitable company, no doubt about that. I mean. But 3/4 of the revenue are coming from a single game. It's a very popular game. I ride the Metro every day, and there's at least 1 or 2 people in the car that I'm in that are playing Candy Crush on their phone or their iPad. It's massively popular. But the question is, what can they do next? And if it's another Farmville situation where they're not able to create the next big game, then they're not worth $7 billion. Which is their market cap at the IPO price of $22.50. They shouldn't be worth half of what Activision Blizzard, for example, is worth, which has several huge billion-dollar franchises behind it, has huge fans, massive recurring revenue, and that to me was just way overinflated. And so I'm glad it's come down a little bit. That said, hey, they've got a great game. If they come out with another home run game, it could be a good investment at much lower prices.
Yeah, it kind of cracks me up just a little bit that we're talking about people finally getting sane, and it's a company that comes public at less than 20 times earnings, and we're like, oh, they sold it off. It's finally sanity. As companies with not a single dollar of revenue are getting billions upon billions, and I completely understand your point. It just there is a nugget of kind of wow here. Yeah. In any case, I think one area with video games that's really interesting to me, and we're going to see more of it in the coming years. People want to apply kind of the old console construct of public gaming companies to a mobile world, and I think that just might not exist. And let me explain that a little in more detail. Essentially, back in the console generation, we had very large companies, and you could look at an Activision Blizzard, you could look at an Electronic Arts, or even like a Take-Two with Grand Theft Auto. A big part of this was there's distribution to stores. So you had to be able to nail that physical distribution channel, which a larger company is inherently better at and has better scale. Not only that, but then you could look at the cost to develop a lot of these games. They weren't developed by small teams. I mean, we're talking, teams for some of these larger games are starting to, border on big budget Hollywood productions. So of course you need good financing in place and you need a large organizational structure to handle that. So it's always been very accommodating to kind of public companies where scale really matters, and you saw some concentration in the industry itself. On mobile gaming, once companies have their hits, they get big. But when those games were developed, it was often from relatively smaller teams.
Right.
So I just don't know if that's necessarily conducive to a large public company. And also, you look at the distribution point of App Store, it's not like, you're getting any kind of benefit being a larger company. Flappy Birds can go up right to the top of the list just as fast as something from a King Digital can. So I think that very much kind of tilts the scale away from, even as mobile revenue is rising, it definitely doesn't necessarily mean it's going to be an environment that's really conducive for big public companies to thrive in that. So I think investors kind of need to calibrate. And as far as King Digital, yeah, I'm personally not too interested in that, just because it feels like a company very much trying to cash in while the good's good.
For sure.
And if you had to look at a company in the industry that maybe has expanded its a little more, it would be someone like a Supercell, but they're not going public right now. So
right, and I have to say I do like the model. I mean, I like the model of you have essentially a free game. You attract millions of users and followers, and you charge essentially for bonuses or for things that will advance you within the game. The bigger players know this; they're getting into this. Activision's got Hearthstone, which is going to be coming out. Well, it's in beta version right now. A massively popular game. It's a similar concept. You play for free, but you're going to be able to buy certain things, or Diablo and things like that, where there's add-ons. So, but I agree. I agree completely. We are in a different world right now, and if you're not nimble, and the big players aren't nimble enough to deal with the next mobile startup, which has the addicting game, they're going to lose out. Their market share is going to decline, and it's going to happen overnight, which is amazing to think about. It's not Activision, like as you said, negotiating distribution deals with GameStop or Walmart or Target. No, that's gone. It's completely gone.
On the other angle, too, marketing, which I didn't even mention, the marketing budgets behind these games. And I might know as well, Farmville 2 recently came out buried on the charts. So there's the wreckage of Zynga. So let's move on to the future, looking at some larger trends that will affect probably the next 5 to 10 years. And hey, what more perfect place could we start with a future segment than Facebook this week buying a virtual reality company? Facebook purchased Oculus for $2 billion. It, I believe 20 months ago or thereabouts, was a Kickstarter project, and today purchased for $2 billion.
Amazing.
Insanity or genius, or somewhere in
Gosh, definitely, somewhere in between. I'm not calling this insane by any stretch. I mean, I think Zuckerberg himself has come out and said, hey, this is the idea of, I have these goggles now, and now I'm engaging in a social world that I interacting with it in a way that I've never done before. I can sit courtside at an NBA game, or I can be in some bar in Dublin, Ireland. Just walk around and interacting with friends in this environment, and it's pretty. The potential is pretty massive. Now, this is a long tail story. This is a story that it's gonna have to play out for many years. It might be 5 or 10 years at least before Facebook even has some kind of application around this hardware. I think $2 billion seems like a big number, and I think it looks. But it's funny that it pales in comparison to the $19 billion that Facebook paid for WhatsApp just a short while ago. But I think there it's like you can see WhatsApp is directly related to Facebook's business right now. So I think Zuckerberg gets a pass there. With this one, he also gets a pass because it's a smaller deal, but it's a deal I think that will be playing out for many years. The interesting question for me around this though is that, like you said, it was a Kickstarter. It was, I think, got $2 million initially in Kickstarter funds, which initially launched the company. They've gotten venture capital since. So, but that's an interesting. If I'm a person who invested in this concept and watched it grow and got excited about it, thought, oh wow, I love this. I love video games. I love virtual reality. I want to see this happen. I put $1,000 in this thing, and all of a sudden, Facebook gobbles it up. How do I feel today? I don't know if I feel so happy about that.
I would say you feel crappy.
I would say
and we've seen people reacting online, and yes, that's how they feel.
Right.
Yeah, when I'm looking at this, it reminds me a lot of Microsoft buying Web TV in 1997. It was a company that was just 20 years old. They purchased it for $500 million, which was a lot at the time. We didn't have the same level of huge deals. And yeah, it was an interesting concept that eventually, in many ways, we do see realized right now with a lot of set-top boxes like Apple TV, Roku, you name it. But it just needed so much infrastructure before it became a really viable technology. The US needed to have broadband, you need to have HD TV so everything wasn't fuzzy, sorry. And it was just too long of a putt for a major company like that to keep focus on and have the patience. Is Facebook going to have the patience to let Oculus grow as it encounters 25 new shiny things across the next 5 to 10 years? My feeling on that's no. I feel like it's just a little bit too ahead. And I just don't see this being a good purchase. But as you had mentioned earlier, Facebook is so big right now, it's basically using its stock to be able to fund these things.
Which is a smart thing to do. I applaud them for that because, I mean, you look at Facebook and even if you doubted their core business, if you said, Facebook's core business in 5 years could be it's not going to be nothing, but it could be having a downturn. Well, that's okay if they make some smart investments right now with a highly priced capital equity that they have. And so far, he's obviously Zuckerberg's making some bets. He's not sitting around. So, and one of those bets, at least a few of those bets, are probably going to stick. Yeah. So. Yeah. It
reminds me, I went on a tour and we went to some Nordic countries. I was actually looking at internet things and some different trends. But one thing we went to was a 3D internet, a university that was making that their core focus. And it was this kind of concept of it being a more social internet, and we used Oculus glasses to be able to explore it, and boom, a month later this happens. So.
Oh, there you go. So you're right at the forefront of everything.
I am on the forefront of this kind of stuff.
It's right here. It's right here.
Boom. All right, so let's talk about wearables. Android on March 18th put out their, I don't even, what was the name for it? But it's Android for wearables. Android Wear, that was the name. How would you think about this affecting really adoption of wearables in mass across the next few years?
My feeling on wearables is it depends on the context. Like, so every day, it's actually in my pocket right now, but I wear a Fitbit every day, as a lot of people do. And to me, it's really a nice, simple thing that I can wear. It connects to my phone. It gives me reports, updates. Oh, there you go. Is that a Fitbit 1? Look at that.
Yeah.
The next. He's got one.
8,200 steps today. Where are you at?
I'm over 10,000 already.
All right.
I played soccer this morning.
Edit that part out.
Okay. Anyway, but so when it's simple and it's intuitive and it connects to other things in my life, I like it. I want to do it. I don't know much about was it Android Wear, so I assume this is the direction it's going. But to me, it's all about making simple connections, making my life easier or more interesting because I'm sort of analyzing things or connecting with things that I wasn't able to before. Anything going down that route is going to be, in my mind, successful. A lot of things you and I saw at the Consumer Electronics Show in January. I'm like, all right, where is this going? I don't see a ready application for this, but to this probably will work.
Yeah, and I think one of the problems with something like Android Wear is that wearables are in such an early stage right now, and people are trying to apply them to kind of all-encompassed, kind of one device is its own platform of sorts.
Sure.
So when you're looking at your watch, it's going to have a screen and you're going to be interacting with it. I think Android Wear has some really positive things from Google because they've been so focused on predictive, basically looking at things like Google Now, being able to predictively look at what information you would like to see and what is relevant to you. So if you apply that to something like a watch, which only has limited screen real estate, you're being able to show people what they most care about, you're learning what they care about, and you're being able to push that to a form factor where you have natural constraints on that. So I think Google has a nice placement to do this, and it's a place where they are likely ahead of Apple. Segue to the next topic, though. I think that people are so focused on watches right now because we've seen watch concepts. We saw Samsung's Galaxy Gear last year, which was a total flop, but it's kind of the first frontier of this. But to me, it's such a small piece of the total wearable story. And I think the total wearable story will be about a host of kind of sensors that you work that are a little bit more specialized, being able to, especially in the healthcare arena, be able to tell you a lot about your fitness and health. And where that processing is going to be won't necessarily be on a watch, it will be on your phone, and they'll be talking to each other and making connections. So the next topic I would want to talk about is actually Apple's Health Book, which has not been formally announced by the company, but we've seen a lot of leaks on. Have you seen any of these leaks?
I have not. I have not. So why don't you give us the summary?
So one of the interesting things about HealthBook, we've seen Passbook in past Apple launches. That's a product which hasn't really taken off. It's supposed to kind of be a payments platform, basically. But here's the deal. The payments industry is already established. There's a lot of very viable ways to go to a store and pay for things, and there's a lot of infrastructure already built out.
Right.
Things like wearables and sensors is something that's not built out right now. And the problem is, if you want to have, here's a Fitbit, which measures something like your fitness activity, but then you also have something that's looking at, blood sugar for diabetics, heart rate. You could go on and iterate on these ideas. You don't want 15 different apps for each low function. You want kind of one place to look at it. You want your data to go to one place, and you want those apps to be able to talk to each other and make meaningful information and connections that informs you about your broader health. What's been so difficult about this is areas like security, all these apps talking to each other, and just having some sort of standard. So what really excites me about HealthBook, I think people might be overlooking it, is it's actually maybe this potential view into the future where apps could go directly, they could just kind of seamlessly kind of install on your phone itself and begin talking to each other. And all of a sudden, once we have that standard, I think you will begin to see that explosion in wearing these because, again, you don't need to have those 15 apps. You have something that just works.
Right.
And when it just works, it's so much more powerful, and it's going to kind of seamlessly affect the background of our life. So that was actually the neatest thing I've seen in wearables across the past year or so.
Well, I like what you're saying is that, so we started off, everyone's focused on the watch because it's like, well, that's something people are familiar with. That's what millions of people are familiar with. Millions of people wear watches every day. So it's like, that's my instant consumer market, right? I can sell, if I have a great watch, I can instantly sell millions of these, maybe. What I like what you're saying is, maybe the focus should be on what markets can we create? What do people don't have in their daily lives? And that's where wearables should be. It's kind of like, what can we provide people? And it essentially invents a new market or a standard. And from what I've heard, that sounds what Apple's trying to do, and that makes total sense to me.
And you look at watches, it's a relatively small market. Healthcare is one of the world's largest markets.
Yes.
So being able to have an entry in there is so much more meaningful, especially over a long term. But let's keep moving on here. My computer's frozen. All right, Airbnb raised $10 billion. Well, they raised less than $10 billion, but at a $10 billion valuation.
Right.
We're seeing Airbnb, and I think that was actually worth more than all but a couple hotels, publicly traded hotel companies.
Not surprised.
I believe it makes it the third most valuable hotel provider. But we're also seeing Uber, which had previously raised money in excess of $3 billion. Do you have kind of any thoughts about maybe these companies specifically, but also the idea of kind of this usage-based sharing of different, I don't know what you want to call it, things.
Yeah, things.
Because this could really expand, I believe, beyond hotels and even cars.
Yeah, the share economy is big. So, in full disclosure, my wife and I have 2 apartments that we rent out through Airbnb in Washington, D.C. And what's interesting is I'm not surprised that you tell me that Airbnb is worth $10 billion because I'm thinking about the amount of money that I've paid to Airbnb and that my guests have paid to Airbnb over the past few years. I essentially, when we rent our basement or one of our apartments out, we pay 3% each time of the total value of the rental. The people who rent it pay between 6 and 10% of their entire stay to Airbnb. I love the platform. It's very easy to use. Airbnb handles all the payments. It handles most of the communication between you and the guest. It's very easy. And if you think about Airbnb from a business perspective, this is phenomenal. They don't have to have, there's not really a lot of infrastructure, not a lot of capital here. You don't have to have even a huge workforce. You essentially just have to have a great network where it's easy for renters and landlords would you say Airbnb rental places to connect. And so that's one example. And as you know, I'm in DC all the time. I've used Uber. I see the car-to-go cars driving around everywhere. There's just a lot out there. There's a lot of real estate out there. There's a lot of mind share out there that hasn't been used or utilized. And this is the share economy is sort of bringing those things together and connecting them. I wonder how much I worry about hotels and taxis and things, things sort of the old economy, things that are used to being done a certain way, and with all these people sharing now, it really disrupts it, and it's doing so not only from that, it's from a regulatory standpoint as well. I mean, cities like New York have even instituted special rules now about Airbnb because they're just worried that all these people are sort of subletting their apartments or renting out their co-ops to visitors, and it's causing some havoc. But it's one of the most disruptive areas of our economy. I'll put it that way.
Yeah, I remember it must have been 7 or 8 years ago seeing LoJack, which is a car security system where you can actually see essentially where your car is on GPS, and I said, wow, the future is amazing. And all of a sudden, 3 or 4 years later, we've got any smartphone, you can lose it, quickly look up on Find My Friends or Google Latitude exactly where it is. So this previously amazing technology is replicated because of the progress of so much in the mobile world.
Right.
And I think a lot of these surrounding kind of advancements in technology are really going to support things like Airbnb as well. So you look at one of the scary things right now. For example, I had asked my wife about using Airbnb for a recent trip, and she just didn't want to have to handle with getting keys and all those kinds of ideas. But you look at something like a Quickset lock system even right now,
Sure.
where you can give out digital keys to people, basically using a thing that's connected, a key lock that previously wasn't connected. So you've got this Internet of Things application where it's going to be able to make a lot of these shared resources so much more compelling.
It's enabling everything that just couldn't be done before.
Yeah, and I think that the more there's all these surrounding technology increases, the more that these kind of services become compelling. And also, I think with a lot of legacy services, people are having a tough time reaching millennials with them. And here's a place that millennials will willingly embrace. You look at something like hotels, you can get a nicer place for cheaper, and millennials will just flock immediately to Airbnb. Right. And also you look at cabs, it's actually, one of the things about hotels is it's a reasonably well-functioning industry. You can get a relatively cheap room somewhere and stay there, and it's efficient. Cabs were wholly inefficient. People didn't take a lot of trips just because you had to pay in cash. The service was often subpar. It was relatively expensive.
There's that awkward payment tip interaction at the end, which takes time, and it's also, yeah.
And now Uber, what I find interesting about that is it can create whole new markets that hadn't previously existed. Gets people taking basically ride-sharing or cab services that previously hadn't. And the idea of people even giving up cars to kind of just take this as an on-demand car service.
Well, that was kind of the bigger point. I mean, speaking of millennials and speaking of the next 10 years, I feel like the idea of car ownership is something that's not going to be. I mean, you're growing up. At least still in my generation, it was the whole idea is like, well, as soon as you graduate from school, got a job, naturally the first thing you do is probably get a car if you didn't already have one.
Yeah.
I think that's totally, I don't know, I think that's totally going away. I don't think, and we can also talk about the larger trend of urbanization as well, as people wanting to live kind of closer to urban centers, walkable neighborhoods, things like that. But that, to me, is enabling the sharing economy, just as much as the mobile devices and then technology, Internet of Things, it's also helping with the technology aspect.
Yeah, so. In any case, we're looking at all these kind of companies like a WhatsApp that gets bought for $19 billion without any real revenues, but future. Here's something that to me, it's kind of interesting because it's physical. It's also deeply embedded in technology. It's being embraced by young people. So it's definitely something that gets me excited. And I would hope that there would be an IPO event around at some point, just because these companies are very interesting.
Absolutely.
All right, and a final segment that we wanted to do was Crystal Ball. This is even further out than the far out stuff.
Oh, wow.
It's a little more theoretical here, and maybe some unconventional talk about some industries people are used to. First one I want to talk about was the Dish-Disney deal. I don't know how familiar you are with this.
A little bit.
But essentially, Dish struck a deal to be able to create a web television service with Disney, which is the first of its kind in the US. We've seen companies like Intel trying to do this for how long, and everyone famously knows about Apple's negotiations, which have been coming up for years now. But one of the interesting aspects of it to me was that they were offering the potential for a personalized television service. Details to be named later. To you, is this the first fracturing of the paid television kind of, I don't know what we would call it, kind of monopoly in America?
You're right. I mean, well, the holy grail of the a la carte, TV service. I can subscribe to the channels that I want, and then I go to and I watch regularly. It could be. It could be. I mean, I think that's the breakthrough a lot of us have been waiting for. The idea that we're paying these huge monthly fees for hundreds of channels and hundreds of points of entertainment that we aren't interested in. You know, and it's anything that can sort of funnel that down to and make it more personal to me and my what I'm looking for. I'm all for it. If this Disney deal is the beginning of that, this is going to happen at some point. And whether it's Apple doing it, whether it's Dish doing it, or Netflix or Amazon, to name two others, it's going to happen at some point.
Yeah, and what I find interesting here is I had talked in the last segment on Uber and Airbnb about reaching millennials because they think differently, especially about digital media and how to pay for it and how the value of kind of digital assets in general. So the CEO of Dish had essentially said one of the areas that we can't quite figure out is how to reach people who are 18 to 34 because they're subscribing to cable in far lower numbers. So you start thinking about something where you have a subscription, but it only enables maybe one tablet at a time to be watching it, and it's cheaper, and you can get things in far smaller packages. That would be appealing to me. It's probably appealing to you.
Sure.
But one of those things, it seems ultimately pretty disruptive to a cable television industry, which only sticks together the way it does because profits are so good to everyone involved. I talked about this in an article I wrote on the industry. The profit margin as of January for Scripps Network last 12 months is higher than Google and Microsoft.
Amazing.
Two companies often considered monopolies. So you see this minor cable player has higher profit margins than them. That's the reason everyone's sticking together because it's so valuable. And when you compare something like an Uber and Airbnb, it was created from the ground up to appeal to younger generations. So when you have something that was created from the ground up to maximize profits and be this really kind of insular industry, and you try and make it appeal to these other groups, what you can often do is fracture that and end up basically dissipating very rapidly all those profits to all but a few players because your model just broke. And I think some people might be surprised how quickly this can happen to television if you continue kind of having these breaks trying to reach these later generations. I think television, either way, pay television in the US is kind of in a rough situation because either, you're going to hold firm and you're going to slowly bleed these people off,
right,
or you're going to try and bring them back into the fold and, again, open up your model to disruption.
Yeah, and I think that's the question. Do executives of these old line cable companies have the courage? I mean, essentially what you're saying is, I need to cut my margin in half, maybe. And if I do that, I can probably reach millions of more customers.
Yeah.
Or I'll do what everyone else is doing, and I'm just going to defend my margin like crazy, and that's why I'm getting paid. That's what my shareholders want, and that's what I'm going to keep doing quarter to quarter. It's going to take an executive with a very long-term vision. And that's what we're talking about here, to make that kind of change. Because they will get disrupted, like you said, there's no doubt about it.
Or someone who can kind of break the union, who's greedy and get some short-term gain, but in the long run, gets kind of a raw deal. All right, and the last topic we want to talk about, I'm going to call this Silicon Valley's shell game, which is a rather ambitious topic, but here's my own idea. And I'll give the basic background, tell me your thoughts on this. Basically, when Facebook came out, and also Twitter as well, you had a lot of people saying, hey, they're cool services who have attracted all these people, but they don't make any money. All of a sudden, Facebook flipped the switch and started making money faster than anyone expected because it presented a new form of advertising in-stream that advertisers really loved. So I believe when you did that, it switched the narrative from, hey, you better be able to make some money on users to get the users, we'll figure out how to make money. Mm-hmm. And we've seen that being evident in their purchase of WhatsApp for $19 billion, essentially making next to no money. I think sub $100 million.
Right.
Case. What I find kind of interesting about this is it's created a situation where any company, no matter how related they are to a potentially game-changing new platform, basically giving or spending as much money as they can to be able to give member statistics and changing users to members. Because suddenly, if you're Yahoo and you have 800 million users coming to your website, you're virtually worthless without your stake in Alibaba. But if you're a new company that has 800 million members, well, you could be worth $100 billion. What are your thoughts on this situation?
Well, so I guess it depends on how what's the distinction? What's the biggest distinction between a user and a member? So the idea is that a member, I'm regularly engaging. I have an account. I'm sharing things with other people. People are coming to this and seeing what I'm publishing or whatever. And so that I agree with that. I think that is the model. But the question is, what I see a lot in the headlines these days is exactly what you're talking about. It's talking about our most active users. Here are statistics behind our site. Things like those are all top of the headline things now, along with revenue as well. Eventually, I feel like we skew a little bit into the sort of the late '90s mentality of building it. We'll build it. They will come. Then we'll figure out how to make money. I feel like a few companies are breaking the model for sure, Facebook being one of them. The question is, I still feel like as we've seen over the past few months with a lot of these IPOs, and it's still about how many people are coming to our site, how many people are engaging with our service. It's not necessarily that we're engaging in a long-term paying relationship with any of these customers, but they're certainly coming. So. Yeah. That's the question, and I see this with a company like Zillow, for example, which has had a huge rise over the past couple of years. And Spencer Rascoff, the CEO there, always says, "Well, advertisers will follow audience. Zillow's got the audience when it comes to real estate." I believe that, but I really want to see those ad dollars come in. I really, it's got to be matched on the top line and eventually on the bottom line. But if all those things are congruent, I think the stock can go. I think a lot of these companies are going to be much more valuable. Sometimes it won't be though.
Yeah, and I guess the main point here for me would be kind of there's going to be a lot of potentially companies that are just basically websites trying to get people to pay these eye-popping valuations based on kind of changing the conversation about their audience metrics. So as a quick example, I'm the managing editor of Fool.com. I will not name the company, but it's a company that just had a very ambitious fundraising round, and they emailed us trying to correct how many unique visitors come to their site each month, which some companies do. It was far higher than any kind of publicly available analytics, but those can be kind of screwy. But they want us to also change the number to million members visit a month.
Interesting.
Because they were trying to change that. So I think there's going to be a lot of companies that are trying to change the conversation from visitors to some kind of members to be able to get in with that next rung of growth. But the only companies that can really support huge valuation based on member growth are potentially disruptive kind of platforms, which WhatsApp potentially could be, but a basic website is not. So I think that, especially as we see a very frothy IPO market, this is one area that investors have to especially be on the lookout, because there's going to be a lot of pretenders to the kind of crown of being these new platform companies trying to come public on high member counts, when really, what's the difference between often a member and someone who just pops by a website? If you're visiting an app, are you a member? Because how different of an engagement is that than just coming to a website a few times?
Right. So it's eyeballs, users, now members.
Now members.
But how do companies define that? And I think that's going to be. I agree. That's an absolutely key point of analysis that we need to take, and all investors need to take on these companies. Exactly what defines a member, and if a company's saying, well, it's a person who interacts with our site maybe on a regular basis. No, that's certainly, to me, still falls in the user quality. And to me, it probably won't be congruent with revenue or the business growth of the company going forward.
All right, well, there you have it, Fools. That's it for this week of The Next. Hope you enjoyed it. We'll be back next week. Fool on.
Fool on.